Hey, it's Ryan Morelli again, and today we're going to talk about stock market and risk. It's safe to say that the stock market is the best place to be when it's going up and the worst place to be when it's going down, unless you have a sound plan. It can be especially bad if you're supplementing your retirement income with this fluctuating stock market portfolio. For those not yet retired but close, I've known people that had to postpone retirement or even come out of retirement because they didn't understand the risk they were taking in the market, lost too much, and had to go back to work. Again, didn't have a sound plan. These people did not have a sound plan to navigate their portfolios with their need for income. As you approach retirement, enter retirement, and for the first several years of retirement, it's tough to see your savings that took 40 plus years to build get decimated. It's also of uber importance to make sure you're set up correctly. And that doesn't mean putting everything in a savings account that's safe but earns nothing. That might be even worse. The US dollar buying power has been in a free fall for a long time. In 2008, what 100,000 US dollars bought only buys about 40,000 of goods and services today. The dollar has lost about 60% in buying power during that time, so leaving it in the bank to protect it isn't helping much either. So where to invest your money when you're near retirement or entering retirement is of uber importance. See, if you're 20 or 30 or 40 years old and you've got 20 to 40 years to retire, you could arguably just deposit the same amount each month into an index fund. If you know you won't need the money, then you're all set. Whether the market goes up or the market goes down, it doesn't matter. You just continue to buy. If you don't need the money, you're adding at lows, you're adding at highs, and it averages out. But when you retire, you're not buying anymore at lows or at highs. You're selling for income. Selling at highs is fine, but not at lows. I can show you two separate portfolios that show an income over 17 years, both with incomes of 25,000, as well as having the same return. But what if I told you that one portfolio had $400,000 more than the other? I'm sure you'd ask, well, how? Well, because in the first few years of retirement, that one portfolio lost 3 years in a row, and that portfolio could never recover. In the next video, I'll go into a solution that many use to avoid this outcome. I've been educating people on this topic for more than 20 decades, and I'm going to give you several free gifts valued at $250. Here's what I'm offering. My book that you should read to be informed about your retirement and assets. Next, my wealth and health guidebook that could save your children and grandchildren a lot of infighting and headaches after your death. Where your financial advisors are, where your safety deposit boxes are, everything that your trust doesn't contain. In addition, you'll gain access to 2 of my video crash courses. If you want these must-have retirement resources absolutely free, simply reply to this email with your name, email, and phone, and we'll be in touch right away. Thanks for listening.